Okay, good afternoon and welcome back everyone to our Monday market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to do something a little different than what we normally do on Mondays, which is usually we talk a lot about education. We stress about option strategies, best practices. We talk a little bit about how to apply them to the current market environment, but we don't spend the whole session talking about the market. So today we're here to give you a different perspective, if you will, provide you with an outlook as far as how we're currently viewing the markets. We'll take a look at everything from predominantly the Canadian markets. We'll also take a look at how they compare to the US markets. We'll take a look at some of the commodities that are important to the Canadian markets, as well as some specific names and sectors within the Canadian markets that we are watching. And then giving you guys a few minutes at the end, if we have some time, to submit questions and symbols that you might want us to take a look at together. But the goal here today is to talk about technical analysis, talk about the overall markets and how we're currently viewing the direction of these markets. So let's go ahead and get started. Before I do, just a quick disclaimer. What we're going to discuss here today is purely for demonstration and education purposes. It is not a solicitation to buy or sell any specific securities. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. For those of you that are familiar with who I am, you know that my background is actually in currency trading, Forex trading. And that's really where I learned how to utilize technical analysis for my trading. And today what I'll do is predominantly run you through a list of charts that I think are important to view at the current moment if you're trading the markets, both across US, Canadian, and different sectors and commodities, and giving you a view of how I would use technical analysis to gain a directional view here in these different asset classes that you might be interested in or you might be trading right now in the Canadian market. So let's go ahead and get started here. Now, first off, I want to talk about the TSX 60, and I'm using XIU, the iShares ETF for the TSX S60. And what I want to first point out here is, and what I have on all of my charts are a weekly chart on the left-hand side and a daily chart on the right-hand side. So you get a sense for long-term trends as well as short-term trends. So the first thing I want to point out is if we look at the long-term, one thing that you might notice here is that the XIU is currently just back around that $24 level, which was important back here in June. It was just important back here in later towards September as support levels. And when we broke below this during the February sell-off, it has just managed to get its way back up to that $24 level. So from a pricing perspective, we are back near what I would consider a big resistance level. So that is concerning usually just from the fact that we're approaching a resistance level that usually you get a bit of a a sell-off here as you approach that resistance level, which we did the first time it touched it. Now, what is encouraging when you look at the daily chart here is that as we approach this $24 level, you have these rising lower lows while you have this $24 resistance level. So if it managed to break back above 24, then you would easily, in my opinion, see a resumption towards that 25.25, which was a major support level even prior to the coronavirus sell-off. Certainly played a role here during the sell-off, 25.25 or so. That would be my target to the upside if XIU can break out above 24, and breakouts above 25.25 would bring you closer to that $27 level, which was the all-time high put in back in late February. So those are the levels that we're paying attention to, especially if you look at the US markets and other global markets that have been looking extremely strong. That certainly would lead us to believe that as a base case, we would believe that this at some point over the next couple of trading sessions or the next couple of weeks will make a significant crack at $24 and potentially move higher from here, as opposed to bouncing lower back towards the $23, $22 level. So momentum is confirming these moves higher. However, there are some smaller divergences that we're currently seeing as markets make higher highs. momentum is not confirming those higher highs. So there are some small divergences that we're keeping our eye out for, which leads us to believe why markets have been predominantly sideways for the past couple of weeks. But again, over the strength that we've seen over the past couple of weeks and the past couple of days, I would say, we are really looking at moves to the upside here for XIU. Now, when we look at the US markets in comparison, the S&P 500, the S&P 500 is significantly stronger because the S&P 500 has resumed back into its roughly December highs and January lows. So those are some of the levels that we're paying attention to right now here on the US markets. The US markets are at near what we consider a fairly key resistance level around 317. 323 is the only real resistance level above before it makes another break back towards 339, which is the all-time high it put in back here in February. Our base case at the moment is still that if it doesn't break above 317, that it's more of a range bound neutral market here between 317 and 300 or so on the S&P 500. That's our base case. If you do get a breakout above, you need to clear the 323 level before it can really start moving that up to 320, 339. Now, as we enter earnings season next week, this is really some of the catalysts that can potentially propel the markets higher. As of at the moment, markets have slashed corporate expectations here for Q2 by about 40% from the same time last year, which is a low bar to set. So that could potentially be the catalyst that the market needs in order to continue to move higher, especially in this environment of effectively what is unlimited QE from all the central banks globally. Zero interest rates, near zero interest rates for most developed countries and many emerging markets, getting closer and closer to zero in terms of interest rates. This is all fortunately or unfortunately supportive of equity markets continuing to move higher. So our base case is keep an eye out for that $24 level on XIU. Well, if you see a breakout above that, you can you could probably see roughly about a 10% move to the upside to about 25.25. And especially if you look at the US markets and you look at developed markets around the world, they certainly are pointing in that particular direction. So from a macro directional view, that's our views for both the US and Canada, regardless of which one you're trading. Canada being significantly weaker than the US markets, predominantly because the sectors that Canada are dominant in are the sectors that are predominantly lagging, which is energy, oil and gas, and mining and financial. These are all three sectors that have been predominantly lagging the markets, which is why XIU is also significantly weaker than the S&P 500, which has a fair amount of technology, healthcare, and communications, which have predominantly driven a lot of the gains that we have seen since the March 2020 lows here in the markets. So that's our view currently from a macro perspective. I do want to take a look at gold, because gold, obviously, a lot of stocks in Canada are in the mining sector. Gold, after taking off from that 1350 level back here in late last year, has continued to move higher. And if you look at the weekly chart, every time it's touched the 20-week moving average, it's been a very good buying opportunity for gold, but it still continues to remain on this fairly strong trajectory on the weekly chart. The daily chart, significantly choppier, but in the same direction. We've had this directional move to the upside over the past few months. It's been much more of a slower grind in gold at the moment. Every single time it touches that 20-week moving average, that has been an opportunity to buy the dip, with the exception of the meltdown that we had during the February and March sell-off here. So those are, outside of that, right now you have a major $1,800 level here in gold that's going to provide some kind of resistance, more of a psychological resistance. Breakouts above 1,800 should continue to see moves up to roughly 2,000 or so. And we can take a look at gold on the charts here real quick. Let's go back a little further on the weekly charts. I want to go back to the all-time highs, which is, you have some major resistance going back to 1800 here or so. So you have, that goes back to 2010, 2012, and 2013. And then you have that last all-time high around 1900. So those are your two major resistance levels here on gold. And if you're thinking about playing in any of the gold mining stocks, these are levels to pay attention to. Breakouts above that $1,800 level will likely send those stocks significantly higher as well. Be very careful because pullbacks here in gold tend to be violent for many of the gold miners. So keep an eye out if you do get some pullback here around the $1,800 level. That usually, in my opinion, is not a great entry point. You either want to wait for a pullback towards a 1750, which is a 20-day moving average to go long, or wait for the breakout if you want to be more conservative and wait for the breakout before you go long. You still have about 100 points to the upside here for gold to reach 1900, which is that all-time high that we put in back in August of 2011. So those are the levels we're paying attention to here for commodities here on gold. Oil is another one that we're paying attention to. One of the things that we want to point out here is oil is near what we consider a major resistance level, around the $40, $41 level, which goes back to 2017 and 2018, where oil bottomed around $40 or so. It has now reached back up to that level, but now as resistance. And the question is whether or not oil can rebound above that level and break out above that level. It's tried multiple times over the past few weeks. If you look at the daily chart, for the past few weeks, it actually has tried to rally above that $40 level. And if we zoom in here on oil as well, one of the things that you'll notice is that it has responded relatively well to the 20-day moving average every time it gets there. That has been a good buying opportunity. And you have this kind of triple top here around this $40, $41 level. And the question is whether or not you can see a breakout to the upside. Breaks to the upside, you will see moves up to about $50 pretty quickly here on oil. But as of right now, and for those of you that follow the fundamentals, isn't particularly strong here on gold rallying, for oil to continue rallying higher, especially as demand globally continues to be relatively weak and tepid. There is a higher probability, in my opinion, of oil pulling back here into the 30s before it can resume potentially a push higher above 40. But it's important to keep an eye out for this $41 level. If it breaks above it with any significant volume, then I would believe that we would start to see oil back in closer to 50 relatively quickly, which obviously would be supportive of the energy names that many of you may have in your portfolios with trading Canadian securities. So keep an eye out here for oil. This is the West Texas Intermediate contract. You can look at other contracts as well. You can look at Brent, you can look at some of the other names, but you have similar types levels here in Brent as well. Brent around 43 or so for that, as opposed to 41 for crude. You can also look at some of the Canadian ones as well, but I use light crude, which is the West Texas Intermediate crude for my analysis. So you can take a look at that. Let's take a look at the next slide here. And then I want to point us to some of the financial stocks, because I think this is really where some of the opportunities that we currently see in the markets. Right now, financials don't look particularly strong. It's actually the second worst performing sector in the S&P. And this is one of the sectors that we see some concerns as far as markets continue to move higher, financials have been lagging behind. And as you can see, we've had this very choppy price action here in financials. And over the past couple of weeks, it's really started to consolidate. And the question is whether it's going to continue breaking up to the upside or to the downside. Now, from my perspective, when you look at the financials, one of the big concerns is that rates for the near future is expected to be zero, if not negative, for many of the developed countries, especially as we continue to see COVID-19 cases grow globally. This is going to put a damper, in my opinion, on the fundamentals that we have on global trade, certainly with travel And this is a concern for a lot of these types of names. And especially if you look at the financials, they have a lot of exposure to the loan book for these type of economies. So that's really where we feel that the risks in the financials are skewed more to the downside rather to the upside, especially in an interest rate environment where their revenues are likely going to be capped from interest rates. So when we look at some of these names, if you look at Sun Life, Sun Life is trading just around its 200-week and 200-day moving, 200-week and 20-week moving average here. And we're looking for potentially either a breakout to the upside or a breakdown. However, we do think that there's a higher probability here of a breakdown if we look at both the fact that this sector has significantly lagged behind the broader market and the fundamental backdrop that you see here within these types of names. So what I wanted to take a look at is how you can potentially play a move to the downside here in names like Sun Life and some of the other financials that we want to take a look at. And we'll take a look at a both balanced view here. If you think that Sun Life can continue to rally up to that $54 and potentially even higher $58 level to the upside, how do you play that? And then if you do think that it's going to move to the downside, how you can also utilize options to do that. So first of all, one of the things I want to point out here is when we look at the S&P 500 VIX, which is the implied volatility of the 30-day options of the S&P 500. One of the things that we want to note, first of all, is that we have broken back below the $30 level, which 30 level, which is significant in terms of the reduction, if you will, in the volatility of the names. And we can directly correlate to the TSX 60 volatilities. However, the thing is to remember is the fact that it's still trading around 27, and it hasn't really declined much since May. And what this leads us to believe is that implied volatility here is going to remain fairly elevated, which generally leads us to utilize strategies that are beneficial for a higher volatility environment, especially when VIX is relatively stable. It's relatively high, but it's relatively stable. These are ideal conditions for selling option strategies rather than buying, especially if you don't believe that there's going to be a big move in one direction or another. Selling option strategies many times is especially in these higher volatility environments, is the better strategy to utilize. So looking at this, if you can sell a 50-48 put vertical here, a credit spread here on Sun Life, if you're bullish, this will collect roughly 65 cents at the midpoint, which is roughly 1/3 of the distance between the two strikes, which here is $2. So 66 cents would be exactly 1/3 of the width here. You're collecting 65 cents, very close to 1/3 of the width. Those are the types of strategies that we're typically looking for if we have a bullish view here on Sun Life. So Sun Life, out of the financials, is actually one of the stronger looking names. It has a very strong dividend yield at the moment. Strong dividend paying stocks are trading at a higher valuation than non-dividend paying stocks. So this is supportive of a potential bullish move here in a name like Sun Life. But if you, on the other hand, are bearish, you might want to take a look at strategies where you're selling a call credit spread instead. So if we look at a call credit spread here where we sell the same 52 call spread here, you're collecting about $1 here on a $2 wide credit spread. The risk reward here on the bearish side is significantly better because you're risking 1-to-1 versus in the bullish trade, you're risking roughly half to what you can potentially risk, or you're making half of what you're risking on that particular trade on the put side. So call spreads currently provide a bit of an edge here versus puts. So the bearish trade is providing a bigger edge to your options trade than the bullish trade here in Sun Life. So those are the ways that you can take a look at options and see how you can play either a mildly bullish or mildly bearish view here in a name here like Sun Life. So this is just to give you an example of the different stocks that we're paying attention to, but also more importantly, how we're playing for either a bullish or bearish move using options so that we are taking those types of trades with limited risk. The key here for all of these trades is really making sure that you understand how to trade these using limited risk. Now, if we look at BMO is significantly weaker than Sun Life because as you can see here, Sun Life is at least within the trading range of the stock within the past couple of years. But if you look at BMO, BMO is significantly still below the trading range that it had over the past couple of years, which predominantly has been in between 68 and roughly 84 or so during the past few years, but currently trading around 54. Now, I apologize. I think that might have been the chart for BMO US. Let me pull up the BMO TSX index, but it's trading at around 72. But so if we look at BMO over the past couple of years, it's been between 88 Canadian and roughly 102, 103, 104 or so. It's been in this very sideways trading range, and it's now broken down to the downside. It has been recently rejected at the 20-week moving average, which is bearish. And over the past, if we look at the daily chart, it's really been range bound here between the 76 and 76 and this triangle that it's formed here. So at the moment, we certainly still believe that BMO is going to trade within this triangle until it resolves itself one way or another. It has not resolved itself outside of this triangle yet. But if you look at the direction at which BMO entered this triangle in, which is to the downside, that would generally lead us to believe that you have a triangle here or a bit of a consolidation range that is likely going to resolve itself to the downside. A continuation of the direction that it entered the triangle in is, from a probability-based perspective, is likely the same direction that it will resolve itself from exiting that consolidation range. It's just that currently it's still in that range, so it's more of a sideways directional view here on BMO. Because it's trading near the upper bound of that range, at the current moment, I would be looking at more for the bearish views, so looking at selling call credit spreads rather than buying put credit spreads. But if BMO was to, let's say, decline down to the $68 level or so, that's when I would be looking at perhaps selling a put credit spread. And then as it resumes back towards that $76 level, looking at selling a call credit spread until it actually breaks to the downside. Then you might want to take a look at strategies like buying puts to play an accelerated move to the downside. But while it trades within this range, my views are more neutral. My views are more along the lines of a small, modest move here on a name like BMO, which is why for this particular name, I would prefer looking at some bearish opportunities, especially as it continues to trade below the $74, $75 level, by selling call credit spreads, looking at selling maybe a 74.76 or 74.78, and collecting roughly $1.30 here on a $4 wide credit spread. That's not particularly attractive here, but if you look at the 74.76, which is $2 wide credit spread here, I'm collecting 75 cents. Now, 75 cents out of a $2 wide credit spread is 37.5% of the width of the distance between the two strikes. That's a little better than the 33% that we generally try to collect. So here I'm collecting almost 38%, which is significantly stronger than what I would typically be looking for. So these are the types of trades that I would be seeking here in this current market environment if you look at those types of stocks. So that just gives you a quick overview of the markets that we're currently viewing from a macro perspective, some of the commodities that are tied to many of the names that you might be trading in the Canadian markets and what our general views are on that, and then showing you how we would leverage these particular views to trade options on them so that you can take these directional views that you might have and do so in a way with limited risk. And the key here is always to manage your risk so that you understand no matter what happens, even if you get the direction correct, you know exactly how much money you're risking here per contract, and you're never risking beyond that. And we really want you to understand that options is a tool to help you manage risk more so than anything else. And when you're able to manage your risk properly and contain your downside, that's when you have the opportunity to potentially make gains to the upside. Because if you don't contain your risk, if you don't manage your risk, all it takes is one bad trade to blow up plenty, tens, maybe even hundreds of profitable trades. And what we're trying to do with options is to prevent that at all costs. So today, this was meant to give you an understanding as to how we're viewing the markets and also how we are utilizing options to play or leverage these views that we have here in the market. So with that, that covers what I wanted to show you guys here today. Oh, and lastly, before I forget, I do want to take a look at Canopy. We've gotten a lot of questions regarding the weed stocks, the cannabis stocks, so we wanted to take a look at this. So cannabis recently had a very interesting bounce off that $14 low, which is, levels that go back to the, roughly post-IPO rallies. It rallied up to that $14 level multiple times before it finally broke out all the way up to that $75 level before it came crashing back down to 14 over the past couple of years. So as we look at that, the question is whether or not cannabis stocks like Canopy Growth have found a bottom here. And if we look at the chart itself, when we look at the daily chart, it certainly has some of the hallmarks of what we would consider typically a bottoming formation. So you have an inverted head and shoulders here. Now, I will say that the strength off of this right shoulder is not particularly strong. We typically want to see, moves to the upside, which we did get, but quickly evaporated after that earnings announcement, which is usually not particularly strong, but it still stays above what I would consider a fairly important $22 level. $22 level, as you can see, played as resistance for a very long time and is now acting as support. So you do have some short-term support here. So risk to reward ratio looks pretty attractive for moves up into this $26, $28 range. As to long-term, whether this can continue to move higher, you have this 200-week moving average here around 30 or so, 29 or so. That, in my opinion, is the upper bound to the upside here in the short run. If you can get a break back above 30, then you open up the races for a much higher move here in marijuana. But if you look at the fundamentals of this particular industry, not particularly strong here. So that is my concern of the broader view in terms of marijuana stocks breaking above 30 or so. I think that you have limited gains above 30. I think that you may have the opportunity to get some short moves to the upside into that $26, $28 level. But as you get into the $28, $30 level, that's really where I think this rally will likely fizzle and perhaps even sell off and use this as more of a kind of a double top play, if you will, here in marijuana stocks. But if it can break above 30, that's where I do think that that is likely where fundamentals have changed, and I would revisit this trade to see if Canopy can continue to break out above 30. So that's the views that I currently have here on the markets. I wanted to share that with you guys and give you a sense for how we're playing this market. So at this point, what I'll do is I'll open this up for Q&A and some of the questions and symbols that you wanted to take a look at. Robert wanted to take a look at GWO. GWO, I don't know a whole lot about this, but it looks like it's an insurance company similar to Sun Life. Now, notice how the chart here looks very similar to BMO, meaning it's trading well below the range it was trading before the sell-off, and it is now trading around that 23. And notice how it's been rejected at the 20-week moving average week after week, which is bearish here in my opinion if it keeps getting rejected at those types of levels. On the daily chart, you have what I would consider a very sideways market. It's just sitting between 20 and 25. It's trading near the upper bound of that range, which leads me to believe that it's likely going to revisit the lower bound of that range, unless you can see a breakout here above 26 or so. I would be more on the bearish, neutral to bearish side here, unless it can get back above 26 on Great West Life. Someone wanted to take a look at, Jessica wanted to look at RBC. RBC is certainly one of the strongest. Wait, whoops, this is not right. This is not it. 1 second. RBC. What is the symbol for RBC? Oh, whoops, RY. RBC, similar, looks a little stronger than BMO. As you can see, it is trading within the range that it was trading from the last few years, between 90 and 107. It is near the bottom end of the range. What is interesting is that RBC has managed to break back above the 20-week moving average. which leads me to believe that it does have some legs to potentially move up to that 200-week moving average, which is around 97 or so, which also happens to be the roughly last swing high that you have here around 98. So I do think that RBC looks relatively stronger here and can potentially make that crack or that move up to about that $98 levels or so here on RBC. Debbie, I have one more minute here. Let's take a look at MFC, Manulife. Let's look at Manulife on the TSX, trading at about 18. Manulife just hanging on by a thread here, as you can see here, trading at around 18, which is a major level to keep an eye out for. Multiple resistance levels here around 18. Finally tested as support and is now starting to break out higher here. So I certainly think that Manulife can potentially rally up to that $20 level, but 20 is a major resistance level that I do have some concerns because if it cannot break up above 20, then that would be potentially a good opportunity to look for some shorts going into that $20 level back into 16. If it can break above 20, that's when you open up the races up until that $24, $25 move to the upside. So Manulife here, until it breaks above 20, I'm still fairly neutral, but I do think short term you could see a move up to that $20 level, but I would pay attention to see if markets sell off around that $20 level here or so. Lastly, I'll take a look at Telus just because it is one of the major names here in Canada. Telus has, the coronavirus hasn't really affected this stock as much, and most of the telecom stocks are predominantly in the same camp here. Telus has been for years a very range-bound stock between 22 and 25, and right now it's trading near the bottom of that range. Now, I will say that I don't know a lot about the fundamentals of this particular company, so it's hard for me to give much guidance or views here on this, but the fact that it's trading near the bottom of the range, I think that you have a higher likelihood of a move to the upside. Again, if you're looking to play Telus here, my preference would be selling names like selling strategies like put spreads here, especially on a name that pays a 4.4% dividend yield in the telecommunications space. Generally speaking, has been relatively strong. So selling a $22, $21 put spread only collects 20 cents here. So unfortunately, this is a stock that I quite like, but the options just don't really line up here for this particular name. So unfortunately, many times with these smaller price stocks, it's harder to find an option strategy that makes sense. So in this particular case, you might want to buy a call, but I tend to find that buying calls here are expensive. You're paying, in this particular case, $1 to pay for a $2 wide debit spread. That, in my opinion, is too much to pay. Paying $1.18 for an August $22 call, that's not terrible because the call is already 64 cents in the money and you're only paying about 50 or 60 cents or so of time value here. That might actually be a better way to play for upside here in a name like Telus, is to simply just buy a call option that's in the money that has quite a bit of intrinsic value. You are risking quite a bit. You're risking $1.18 on a $22 stock, which is roughly 5% of the underlying stock, to just to place a bet for the next 46 days. You might want to go a little longer term. Going out to November, buying the $22 calls cost you $1.54. This only has about $1 worth of time value, but you get all the way out to November. So, if you're bullish here on Telus in the longer term, I would be looking at something like a November call option here to play a move here in Telus. So with that covers what I wanted to show you guys here today. These are meant to be very quick, 20, 30-minute sessions as far as what we're currently viewing on the markets, giving you an opportunity to take a look at a few symbols together, showing you how we would play these types of names using options to limit our risk. Again, these are volatile times. Things are changing week by week. You want to make sure that you protect yourself, because what ends up being what looks like a really great trade but might reverse itself very, very quickly. And the only way you can prevent drawdowns like this from blowing up your account is to use strategies that you can protect your risk to the downside. Options is one of those tools that you can utilize to protect yourself and manage your risk in these types of events that are hard to predict and or impossible to predict, and making sure that you are utilizing them correctly so that you have strategies that have limited risk. So that's the goal of these strategies. We're here to do these every single Monday for the next few weeks during the summer sessions as things slow down with education, to give you a sense for how we are viewing the market. So with that, thank you so much. I hope that you guys find this useful. We will see you guys here next Monday again for the same session. Have a great afternoon and a great week.